Hello everyone, I am Old Fish. If 2024 was just the warm-up, then in 2025, we are standing right in the middle of a gold bull market that is all but guaranteed. But make no mistake, this isn't just about market hype. This is driven by a historic convergence of three fundamental drivers. Number one, the de-dollarization frenzy. Global central banks are buying like crazy, locking in a floor for gold prices. Number two, the rate cut cycle. As real interest rates drop, gold's valuation is being pushed directly upward. And number three, geopolitical instability. Chaos has become the new normal, making safe haven assets a rigid demand for capital. In this macro environment, allocating gold is no longer an elective course. It is a required course. However, the more obvious the trend, the cooler your head needs to be. Many people think buying gold mining stocks is playing it safe. But the moment the broader market corrects, those mining stocks can crash harder than tech stocks. You got the direction right, but you still lost money, simply because you chose the wrong tool. So today, we are going to dig deep into Canada's mainstream gold ETFs. From physical bullion to mining companies, all the way to high-yield covered call strategies. First, let's look at the true safe haven asset, physical gold ETFs. The logic here is simple. The fund company takes your money, buys gold bars, and stores them. Since the underlying asset is identical, the MER, the management expense ratio, is the only battlefield that matters. Let's look at CGL. This is the most popular tracker with the best liquidity, but its management fee is a steep 0.55%. Compare that to the current cost-cutting champions in the market. CICE VALT and Purposes KILO. VALT's fee is only around 0.18%, and KILO is just over 0.2%. You have to remember, gold itself doesn't generate interest. A 0.4% difference in fees, compounded over time, will eat away a significant chunk of your profits. So, if you are doing long-term asset allocation, do not hesitate. Swap CGL for VALT or KILO. There is one special breed, MNT. This is issued by the Royal Canadian Mint. Its underlying safety is unquestionable. But what makes MNT unique is that the Mint issues a fixed, limited number of receipts. This structure causes the market price to frequently detach from its net asset value. In my view, this is a sharp, double-edged sword. In a bull market, its premium often spikes. Buying then means you're paying an expensive emotion tax to buy at the top. Conversely, when it trades at a discount, it's a golden opportunity to buy gold on sale. So, trading MNT requires you to exploit market sentiment, not be harvested by it. Always check the real-time net asset value before placing an order. Before we talk about miner ETFs, we need to distinguish between physical gold and gold companies. Many think, mines dig up gold, so mining stocks are safe havens too. Is that true? You must understand this underlying logic. Physical gold, like VALT or CGL, is a commodity. It is an inanimate object. It is your shield, used to fight inflation and protect against crashes. Gold mining enterprises, like XGD or ZGD, are companies. They are a business. Miners have operating leverage. What does that mean? Let's say gold prices rise 10%. Because mining costs are relatively fixed, the miners' profits might explode by 40%. This means, in a bull market, miners will far outperform gold. But in a bear market or during a liquidity crisis, miners are viewed as high-risk equities and get sold off indiscriminately. So remember, if you want defense, buy physical gold. If you want growth, buy mining companies. If you have decided you want growth, which miner ETF do you choose? There are two giants here, XGD and ZGD. First, XGD. This is Canada's largest gold miner ETF. It uses market cap weighting. Giants like Newmont and Barrick make up a huge percentage. Pros? It's stable with unbeatable liquidity. Cons? Concentration risk. If a top company has a mine collapse, the whole ETF gets dragged down. Second, ZGD. Unlike the other one, this is equal weight. Whether you are a $100 billion giant or a mid-cap, in ZGD you are equal. Why is this good? In gold bull markets, mid-cap stocks often rally much harder than the big caps. ZGD allows you to capture that explosive growth. Looking at the 5-year performance, ZGD's long-term return significantly outperforms XGD, leading by nearly 100 points. So, if you want stability, pick XGD. If you want higher elasticity, ZGD is likely the better choice. Finally, if you are like me, a passive income investor focused on cash flow, then take a look at HGY and GLCC. These are covered call ETFs from Global X that generate monthly dividends by writing call options. First is HGY, the physical gold version. It yields around 5%. This strategy overlays covered calls onto physical gold price, but without any leverage. Now, Global X's strategy is dynamic. They typically cap the writing coverage at 50%. In a bull market, they actively reduce that coverage, allowing the underlying asset to capture more of the price appreciation. However, you need to be aware of the math. A non-leveraged covered call ETF deals with management fees and a capped upside. Therefore, in a strong bull market, it is practically guaranteed to underperform the raw asset. Let's look at the performance comparison, specifically total return, which includes dividends. As you can see, HGY lags behind CGL by quite a margin. On the corporate side, Global X offers GLCC. This is the covered call ETF for gold miners. The yield here is higher, about 7% to 8%. Why? Because mining stocks are more volatile than physical gold, which makes the option premiums much more expensive. The strategy structure is identical to HGY. In a bull market, they won't cover the full 50% of the portfolio, allowing you to eat more of the upside. But let's look at GLCC's performance. Again, looking at total return. While the returns are decent, when compared to uncapped ETFs like XGD and ZGD, there is still a performance lag. This is simply because GLCC lacks the leverage to offset the capped upside. Actually, GLCC does have a 25% leveraged version. The ticker is GLCL. Its performance tracks much closer to standard miner ETFs like XGD and ZGD. Although GLCL is a new listing this year, its underlying asset is simply a magnified version of GLCC, so we can easily project its future behavior. It is definitely worth adding to your watch list. Let's wrap up with my personal take. If you are buying gold for defense or portfolio diversification, stick to physical gold ETFs. My top recommendations here are the low-fee leaders, VALT or KILO. You might ask, why not HGY for dividends? Well, first, its yield isn't particularly high. And secondly, since it lacks a 25% leverage version, it is mathematically destined to significantly underperform the raw asset over the long run. If you prefer something more aggressive, if you are betting on a weakening US dollar and want to amplify gold's gains, consider allocating to ZGD. Alternatively, if you need a cash flow position to harvest dividends, consider GLCC or GLCL. GLCL carries 25% light leverage. While this amplifies volatility, it effectively allows its total return to track closer to the likes of ZGD and XGD. Finally, I hope this video brings you some value. I'm Old Fish. If you like this content, don't forget to like, leave a comment and subscribe. See you in the next one.